Suzanne, you have an interesting perspective because you are you're an investor. You invest in emerging markets. You do it around the world, and you do it in Africa. And perhaps you could give us the perspective of international investors and how they view entering Africa and what the limitations and the difficulties they have doing it, and what they look for, what they will look for to do this.
Thank you very much. I am here from the UN Joint Staff Pension Fund, and we are the fiduciary for the United Nations and 23 other agencies, funds, and programs which have combined their resources to have a very cost-effective managed pension fund. As of yesterday, we had $44 billion under management. We are the most global pension fund. We have liabilities to pay pensions to staff members who choose to retire at home, which could be in any of 194 member states. For that reason, we're interested in every part of the world that gives us an opportunity to earn the proper rate of return. And Africa has some very compelling economic statistics. We were looking around early on to invest through funds because our staffing level is quite low. We have only one office, which is in New York. And so even though we may be a global fund, we don't have offices anywhere except here in New York. That led us very early on to collaborate with other pension fund managers in the world. And fortunately, we have visited and gained knowledge from colleagues even at this table, from meeting with the Pula Fund in Gaborone, where our investments committee met earlier this year. And I had the pleasure of visiting Zanzibar also. So we are with kindred spirits on this panel. As far as the economic opportunities, we're looking at a number of themes. The urbanization of Africa is compelling. Just from 1990 and expected to 2020, the urbanization will be growing from 32% to 45%. But how do you get that when the stock markets themselves are relatively illiquid? I have visited the Johannesburg Stock Exchange, which of course is the big one, Lagos Stock Exchange, Nairobi, Dar es Salaam. But a $44 billion fund can't place an investment quickly or liquidate it quickly. And one of our prime watchwords for our investments is liquidity. If we can't get liquidity, we have to look for other investment vehicles. In order to increase our exposure to Africa, we determined that the best approach was to look very carefully at ventures in our own kindred spirits. So we invested with IFC, part of the World Bank, in their private equity fund. And that's allowed us to gain exposure to markets that are growing very rapidly. They can capitalize on the growth in infrastructure and the regional integration themes, which I think are also going to be compelling for investors. Transparency is an issue. And again, working with IFC, World Bank, we have some access to people on the ground who can gain knowledge from being present. I think that when you're in a liquid investment such as private equity, investing with people who can monitor things quite closely is a big advantage. And I think the development of more commercial private equity funds may be a very interesting investment angle for other pension funds, both here in the United States and globally. You're not going to get better growth rates elsewhere in the world than you're going to get in Africa in the next few years. We see a lot of people saying, oh dear, Africa's so dependent on primary exports, things like materials, minerals, and fuels. This is true. 74% of exports in 2010 from sub-Saharan Africa were in that category. But I think the consumer statistics and the urbanization statistics tell us that there's going to be other angles of opportunity. And if we pension funds can discuss what these opportunities are, maybe have a meeting of this kind in Africa, attracting some of the international investors, I think that people would start to see what we have seen in the UN's fund. This is a very rich investment climate. We see improvements in governments and governance globally, but in Africa, we have some leadership. The reason our fund met in Botswana was the Pula Fund is a model of governance that we think other people should follow, and they're actually leading ahead of us in their exposure to alternative assets. Our exposure, if you include our real estate, which is 5%, and our private equity, which is not even 1% right now, of 6%, is quite behind the advanced position of the funds in Botswana. But we're learning from them, and we will hope to learn from other investors in Africa as we build our portfolio there. There are some funds which by design, and I'm thinking of the Norway Fund, for example, that do not invest in their home country. And that is for a specific fiduciary reason. By and large, however, I really worry about investing in a country where they don't invest at home. So I'd like to see some balance between capital flight and building their own economy. And this is another area where collaboration with other pension funds can tell you what's happening. I mean, you want a commitment to the home market, but also a balance because they're fiduciaries too. And it may be in their fiduciary interest to have diversification the same way we do. It's certainly been protective of our fund.
Doing business in Africa, you can't afford to be without Africa Investor.